I think it's a very good graphic about the new normal. I talked about this quite a bit in the past presentations. And what the new normal is that the Fed is empowered to look at unemployment and levels of employment and look at keeping prices stable. In order to maintain prices when everything was collapsing around, they needed to do those injections and they accomplished it. The hangover is to take some of that stuff back out. Like, how do you slow the economy down? And there is a lot of talk about we're going to get through this without a real recession, a full blown recession where growth is low and unemployment is high. So what I noticed in the data as we are coming out to that long expansion was that there were plateau periods. And you're seeing here the stock market prices, the New York Stock Exchange price levels, and that's an indicator where money's coming out of the system and prices went up and then they plateaued and they stayed that way. How long did they stay there until the next round of growth in price levels for assets? And that's what the key is right now. How long is this going to last? We can see that we're going forward across at the top of the page. We don't know how long it's going to last. We can see these previous episodes of growth recessions and how long they lasted. So here's this labor force. So the Fed's empowered to look at the labor force and looking back over a long period of time, and this gives us some insight how long those deep recessions went with respect to unemployment. And you can see that it's very short for this one. It barely made the radar before employment came back after the pandemic. So these actions are aggressive and they shorten these timelines, and we hardly feel the pain. So here we're looking at the growth part of the growth recession with these horizontal lines, how long they lasted, 2011 through 14 and so on, where growth got below 2%, and how long was that? So the issue that we're facing now that was different from the growth recessions that we experienced from 2010 on through to date is that we did not have price inflation problems. In fact, inflation was below target through that time. We didn't have enough inflation, and that was part of the new normal. We got to get inflation to our target. It's below it. We got to get it above. But we got the opposite issue now. It's above, and we got to get it below. How long that lasts is the big question, and it likely will last a little bit longer than the previous growth recessions because those price levels are high. So it's all eyes are on how quickly the price levels in PCE, consumer prices, drop, and how hard do we need to go. And right now, the Fed's staying put. They're not going up any further. They're watching things decline. Real interest rates are out there. And hopefully it works out for the best, but be prepared for this being a little bit longer. It's not going to be the sudden movements we saw with the onset of the pandemic. The lower line shows what we were talking about with respect to the Fed needing to hit its inflation target of 2%. There was a long period of time where they were under target and the economy was underperforming. Therefore, they created this new normal that said we are literally going to inflate and we are going to get to our target. So they're now getting above that 2% long term. And of course, they're going to come down and do everything they need to do to hit that again. And the relationship between non-residential construction and the overall economy is roughly times two. We've got a long term that's trending towards 4%, and the Fed's trending towards 2%. And that's the difference between a microeconomy and a macroeconomy. Yeah, soft landing is definitely what would lead to that 4 to 6% range. Like I said, roughly double what the Fed is targeting for consumer prices, right? 2 to 3% is what they're hoping for in 2024. Bidding contingency, we started the pandemic with recommendations in the 5 to 15% range. And we are starting to come into a position where very few of our projects are using bidding contingency. We're still suggesting a 0 to 5% range, depending on the region, depending on the project.